In an industry where a company that's a long-term investment is hard to find, there is one gold company that may pique your interest for gold investing, and that is Sandstorm Gold. Sandstorm Gold is a royalty and streaming company that provides capital to gold mining companies in exchange for a cut of the gold that they dig out of the mine. And Sandstorm buys that gold at a low fixed price, typically around $400 per ounce on average. There are a few gold royalty companies out there, but we think Sandstorm is worthy of your own due diligence. As a disclosure, we are proud shareholders of the company, and although we hardly advertise gold stocks, we believe in the Sandstorm management, led by former executive of Silver Wheaton, Noland Watson. Sandstorm is geographically diversified with exposure in North and South America, Africa, and Asia, and has 21 producing assets that have netted them an increasing amount of positive operating cash flow and revenue in the past 4 quarters. They also have 22 mines in the development stage that will increase their cash flow substantially in the next few years. Be sure to check out Sandstorm Gold at sandstormgold.com/invest. Hi, everyone. This is Jason Barrick of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. He is a student of the Austrian School of Economics, and he has over 25 years of experience working in the financial industry, including working with Bill Fleckenstein's hedge fund and David Tice's Prudent Bear Fund. He's also been writing the popular Credit Bubble Bulletin and his other blog before it became the Credit Bubble Bulletin since the late 1990s, and now he's working with David McAlvany over at McAlvany Financial. I believe they're starting some type of a short fund for retail and high net worth investors. Doug Noland, thank you for joining me.
Hi, Jason. Thanks for having me on today.
Now, Doug, you've been documenting a lot of bubbles collapsing, credit bubbles, debt bubbles for a long time now, longer before I even got interested in investing in finance. What's your opinion of the state of the global economy right now?
Yeah, Jason. Actually, my analysis goes back to back to 1990. And I've been following developments, extraordinary developments, especially in monetary matters, government policy, markets for this is 27 years now, I guess. Back in the 1990s, I was convinced that finance had fundamentally changed, and with Fannie and Freddie, the GSEs, mortgage-backed securities, asset-backed securities, Wall Street finance, all the derivatives, I was convinced that this was such a major change in finance that wasn't appreciated, and that this kind of unfettered finance was inflating dangerous bubbles. And and I actually titled my blog back in 1999, the Credit Bubble Bulletin. Never did I imagine that I would still have bubble in the title in 2017. I thought the bubble was going to burst. Actually, I thought it burst in 2000. Then I had to reverse course in 2002, and I started writing saying, this is now the mortgage finance bubble, and chronicled that all the way through. And I thought the bubble was over, 2008, 2009. Well, I guess it was April 2009, I had to change my tune again and say, wait a minute, we now have the global government finance bubble, and I labeled it the granddaddy of all bubbles. And I've been chronicling this now for how many years? And unfortunately, from my analytical perspective, I think this is by far the largest, most dangerous bubble in history. It's a global bubble. And candidly, you look at the global economy, and the optimists, the bulls, can look and say, okay, things look okay. They look okay. Well, I just think the underlying finance is unsound. It's a global bubble in all types of asset classes, deeply systemic. So unfortunately, I look at this, I'm very alarmed with how this has developed and apprehensive as far as the future. And I just hope I'm too dire. I hope I'm wrong on this.
Yeah, I hope I'm wrong too, but when I look at the real economy compared to asset valuations, I see asset prices that have soared since 2008. There was a reflation of those bubbles that had collapsed, and an attempt at creating new credit bubbles, new asset bubbles, new types of bubbles all over the globe. And the reality of the real economy that I see, I see evidence that the real economy is not doing well in a lot of cases. We have millions of listeners on this program all over the world. And what they tell me, is for the most part, their bills are going up, their standard of living is declining. Maybe, if they're a hedge fund manager with easy access to extra credit, easy low interest rate credit on Wall Street, they can trade and make a lot of money. Or if they're a technology entrepreneur, they're doing well. But the majority of people in the United States and Western Europe and other countries are not doing well at all.
Yeah, that's true. Considering the amount of monetary stimulus, and we still have, it's about $2 trillion annualized global QE right now. And here in the U.S., no one even talks about QE anymore. It's like it doesn't matter. Well, it does matter. There's enormous amounts of QE globally. A lot of that finance makes its way into the U.S. So considering the monetary backdrop, the global economic situation is not impressive at all. And what I've always said, Jason, is that bubbles are really about the redistribution of wealth. And we've seen it. We've seen it in this country where, the 1% has done very well. The average worker has not done well. That's the makings of a bubble. And what makes me very concerned is on a global basis, you have this redistribution of wealth, and that leads to a lot of tension. We've seen it in this country, politically, socially. Now we're seeing it in geopolitical tensions. All these countries want to get their own, make sure they get their slice of the pie. Well, the problem is the pie is getting smaller now. During the upside of the bubble period, there's this sense of prosperity, integration, cooperation, and that feeds on itself and leads to the perception of prosperity and a lot of wealth creation. Well, the downside of the bubble is, the disintermediation from finance, disintegration of relationships, lack of cooperation. We're seeing that globally. So that's not going to help the global economy create wealth. And now we have all this perceived wealth out there that could disappear in a bear market, and that's when you'll really see problems. In my work, I look at the household balance sheet, and right now the household sector in the U.S. is at record net worth, basically record net worth to GDP. So a lot of people are feeling pretty good because they have money in the markets and the markets have done well. That wealth can evaporate rather quickly, though, as we've seen in past bear markets.
Yeah, I know you're a fan of the Austrian School of Economics. So, when these credit bubbles and debt bubbles do burst, that's the free market trying to exert itself and trying to do the cure. But the interventionists, the central planners, the people who believe in Keynesian economics, they believe that is bad, letting the free market work, letting firms fail, bankruptcies, people who are irresponsible with their assets are forced to liquidate. I think that's good for the economy long term. But, since 2008, we've had basically too big to fails and preventing bankruptcies, and that just creates more and more moral hazard in the system, more malinvestment. You brought up the government statistics there. I think that's an important thing because the government, I think, whether it's China, the United States, Europe, Japan, I think they're all using phony government data to try to make their asset prices go higher. I think, these central bankers, Doug, are totally terrified of asset prices falling. Did you see that story that came out in the Wall Street Journal where there was an IMF poll recently and 80% of central bankers plan to buy, in a poll, plan to buy a lot more stocks, corporate debt, and government bonds in the near future. And I'm just scratching my head, when you look at valuations, why they would plan to buy at these levels.
Well, that's part of the danger of these bubbles. The bigger they get, the more dangerous the bursting, and the more you get government intervention, and that's all facets of government, certainly including the central bank. I'll go back to 2012. I think the global financial system was on the verge of a very difficult financial crisis. You had a crisis of confidence in Italian, Spanish debt. The markets were starting to question the solvency of the European banking system and starting to question the viability of the euro. And you had concerted central bank intervention, aggressive intervention from Draghi's whatever it takes, and then the Federal Reserve reinstituted QE, the Bank of Japan did. So I think going back to 2012, that whatever it takes central banking, they went down a road that they're not going to be able to get out of, unfortunately. because once you stimulate the markets like this, you're going to have to keep stimulating them. It's not like you can just back away from stimulation, back away from QE, and the markets will be fine. They will not be fine. So we'll see. There's rumblings in Germany, a pop in their inflation rate, a lot of pressure in Germany to rein in the ECB. The Bank of Japan is still aggressively doing QE. So I think the markets could have a rude awakening, and these central bankers, I'm not sure if they appreciate kind of the monster they have created through now years of QE and multiple trillions of dollars of just new liquidity thrown into the marketplace. So, I think it was desperate measures back in 2012, and I think it was desperate measures about a year ago. A year ago, if you recall, Jason, the markets were under a lot of pressure. There's fears of China, there was fears of the emerging markets, and importantly, there were fears that central banks were out of ammunition or nearing the end of their stimulus. Well, you had the last aggressive move by the ECB and the Bank of Japan. The Fed, put rate hikes on hold, and the markets took off. And to me, it's kind of this final stage of a multi-year, speculative bubble marketplace, and we'll see how it plays out.
Yeah, it's almost like von Mises's crack-a-boom. I mean, we'd have to have asset prices continue to soar, but I mean, they're just above rational levels right now, considering underlying fundamentals in the real economy. You brought up some points there about 2012. I think that was the year that there was a crash in the futures market that year based on the European bonds. It was the year 2011 and 2012, and there was an emergency central bank meeting, emergency late night phone calls, with coordination of these central bankers. God knows what these central bankers are actually doing behind the scenes. I've heard from one of my sources, and we know this also from a one-time partial audit of the Federal Reserve and a Freedom of Information Act request, that they've released trillions of dollars in currency swaps to the European Central Bank to delay the European banks from collapsing. So who knows how much of that they're actually doing. But in January of 2016, you brought up, we had one of the worst Januaries, I think, in many, many years. There was a 10% drop in the Dow. And normally, when you start off a January that bad in the stock market, it foretells even worse. And yet, it magically reversed. The plunge protection team, or whatever reasons it was, the correction that happened that would look like it was going to get really bad, it just magically reversed, and the Dow ended up outperforming gold in 2016.
Yeah, and last year also, there were fears of a major unraveling in China, along with fears of, central banks running out of ammo. Well, you had extraordinary intervention by the Chinese officials, and you had this enormous expansion of credit early last year in China that it carried through much of the year. So China ended up in 2016, rather than to have a credit accident or potential financial crisis, they had record credit growth of about $3 trillion. So between that $3 trillion of Chinese credit and the QE, especially from the Bank of Japan and the ECB, that was enough liquidity in itself to turn it around and get the inflationary bias back in financial assets and commodities, somewhat too. So it was extraordinary year.
I want to ask you now about a strong dollar. Ben Bernanke, prior to doing all these quantitative easing programs, if he would have done a press conference and said, we're going to print all this money, we're going to give a lot of it to Wall Street and the banks, and our balance, the Federal Reserve balance sheet, our balance sheet, although, it doesn't represent the citizens, but Ben Bernanke's talking here, and our balance sheet would go from $800 billion to $4 trillion in only a couple of years, the dollar index seems to me like it would have gone down a lot. And yet that's not what's happened in reality. What type of damage do you think to the global economy and to asset markets can a strong dollar do on the dollar index if it continues to if it stays strong at these levels or gets stronger than even 105 on the dollar index?
Yeah, the currency markets will be very interesting. Right now, the consensus, especially in, I call it the leverage speculating community, especially in the hedge fund community, that it's dollar bullish. So there's a lot of positioning right now based on the strong dollar. So I would almost argue in the short time the most disruptive move would be a significant decline in the dollar that would catch a lot of leveraged players on the wrong side of trades, especially, let's say, if the yen rallies versus the dollar, because I think there's a lot of shorting of yen to play higher yields around the world. Going back to Ben Bernanke, what he said, and it didn't get enough attention. In 2013, he ended up saying the Fed would push back against a tightening of financial conditions. And basically what that means is the Fed's right there. If there's any issue in the markets, let alone a bear market, if there's an issue in the markets where you have a tightening of finance in the markets, which that's what a bear market is, and that's why you need bear markets to wring out some excess, that the Fed was going to be right there to push back to add liquidity. That changed the whole backdrop, because at that point the Fed didn't even have to do QE, because it basically promised we're right here to backstop the markets. If there's any problem, we'll reinstitute QE. It reminded me a lot of back in the 1990s when there was any liquidity event in the markets. 1994 comes to mind, 1998, 1999. You would have Fannie and Freddie aggressively add liquidity by buying mortgage-backed securities in the marketplace. So these markets now, for literally a couple of decades, have had this backstop that encourages leverage, that encourages speculation. And that's one of the unknowns going forward, through 2017 and after that. Will the Fed actually make good on that backstop? The next time we have a risk off in the marketplace, another one of these flash crashes or whatever, does the Fed immediately come in and add liquidity? If they don't, the markets are going to have to reevaluate this whole backstop bid that Chairman Bernanke made very explicit to the markets.
Yeah, well, I don't think the Federal Reserve can continue to do these 25 basis point increases. We know the Federal Reserve's track record the last couple of years is not doing what they say. They have a long track record of actually not doing what they say. But in 2015, they promised 3 interest rate increases. They did 1 in December. In 2016, 4 were promised. They did 1 in December. This year, I think they're promising 3. This year, they were actually supposed to be more dovish in their projections compared to others. They're only promising 1. But they said they may do 3. If they do 3, though, Doug, I think, that would intentionally be collapsing the asset markets, and that could potentially drastically raise interest rates. It seems to me President Donald Trump doesn't want a stronger dollar. He's come out and spoken that he doesn't want a stronger dollar. When I look at some of his spending policies and economic policies that he wants, it seems to me he wants to do some type of supply-side economic stimulus. So this could be a big headwind. It could be a potential battle, then, of Donald Trump versus Janet Yellen.
There's so many interesting facets of this. And in my latest bulletin, I even posed the question, if the markets react negatively to some of President Trump's policies, will the Fed be as aggressive to come in with this backstop bid for the markets, or maybe the ideology of the Fed is that they're not pro-Trump policies today, and they'll be less willing to come in and backstop the market. How well do central banks work together globally now if these governments are at odds, right? And I pose the question, if we get into a trade war, do we expect the Fed and the Bank of Mexico and the People's Bank of China to work closely together as they have over recent years? And I agree with you. President Trump I don't think he's going to be a big fan of the strong dollar. And this changes the rules and leads to a lot of uncertainty. And also, do we see tweets going forward as far as ECB policymaking and QE from the Bank of Japan and the ECB? And that's the QE that's kind of driving global liquidity right now. And Trump could be very much against that because it's basically currency devaluation. So this is going to be very interesting over the next coming months to see how the markets react to the new president.
Yeah, I completely agree. And it's kind of head scratching because initially, in order to get elected, Trump was bringing up populist arguments from saying things that you and me would agree with, that the Federal Reserve was manipulating interest rates, that the stock market was a bubble, that these asset markets, the Federal Reserve has created misallocations of capital and created a bubble. And then once he won the election, he started taking credit for Dow 20,000. So he better be careful about, flip-flopping and switching sides there like a politician. I think all politicians, though, Doug, none of them want a strong currency. They all want, the central banker and the Treasury to give them whatever they want, and they love to spend other people's money.
Sure. And my guess is, and this is just a guess, that, today President Trump enjoys the markets at record highs, but if the markets react negatively to his policies, and, we've already seen the markets start to, act a little nervous. I don't think that he's going to care that much about the stock market. And I could be completely wrong on this, but he doesn't strike me as the type that's going to sit around and worry about what the stock market does when he announces, some policy changes.
It may be that way. I mean, how many executive orders, you talked about this in your weekly column, his executive orders are just coming at a fast and furious pace. And I don't agree with a lot of his executive orders. God knows, both parties, Republican and Democrat, have trampled on the Constitution. But at least he's, doing what he says for the most part. And the Democrats and the mainstream media are shocked that he's actually basically doing what he said in his campaign promises to get elected.
Right, and I'll also make the comment about the markets. Going back, we were talking about a year ago in January, the markets, they were kind of bearishly positioned. A lot of people had hedges on. Well, the policy response back then led to a big short squeeze, and the markets took off, became very speculative. And then going into the election, there was a lot of hedging and shorting just to protect against, uncertain events. Well, when Donald Trump made his, we'll call it a conciliatory acceptance speech, didn't attack Hillary, didn't do anything crazy, then immediately the market started this short squeeze and unwind of hedges, and those things always take on a life of their own. That was powerful. The bears got blown out. And in my view is the markets always, or the news always kind of follows the market. So the markets are going up. So of course, they're going to look at Trump and pick the positive, tax reform, tax cuts, deregulation, infrastructure spending, and the whole viewpoint's positive, and it feeds on itself, and the market keeps going, and everybody has to jump on board. Well, as soon as the markets turn down, then the news is going to change, the analysis is going to change, and there's going to be focus on a lot of these things that are not market friendly. That's just kind of the way the markets work, and I don't think it'll be too long until the narrative is going to change, and it's not going to be bull market forever on the back of Donald Trump, but we'll see.
Yeah, you said in your weekly missive that you think this is reminding you a lot of 2007, how things, there was some positive economic data then, and yet, we all know what happened, that 2007 was the calm before the storm as things started to rapidly accelerate towards the end of 2007 and into 2008 with the mortgage-backed securities, the banks, the real estate bubble, the subprime going bad, etc.
Right, and again, I hope I'm way too dire, but, I was very nervous back in 2007, and, I chronicled the bubble, and I was very worried about the bubble and the consequences of its bursting. But I'm much more worried today because of the global nature of the bubble and the geopolitical instability and high risk out there. Back in 2007, the fundamental issue was finance was unsound, right? You had these mortgage-backed securities that were crazily valued in the marketplace and all these homes, and what people didn't appreciate was how this mispricing of finance, to the tune of trillions of dollars of securities, really, this mispricing of finance was having such an impact on the structure of the overall economy. And this is Austrian, right? This is Austrian analysis. So basically, hardly anyone appreciated the fragilities of the finance and of the economy. Well, today, I think the distortions in finance, the mispricing on a global basis is so much more dramatic than 2007. You had mentioned the underlying fundamentals and valuation based on fundamentals. Well, in my framework, these bubbles inflate fundamentals, right? I don't think today's earnings are sustainable because I don't think global finance is sustainable. So I just think the markets could drop dramatically. You could get a lot of instability in the currency markets. What we also have is I think last year's aggressive, we'll call it desperate measures from central banks also pushed sovereign yields to historic lows in the bond market. That was a historic bubble where there are cracks, but I think bond yields today would be a lot higher if not for this $2 trillion of global QE. So we could go into a financial backdrop where you have pressure on risk assets, but you also have pressure on the so-called, safe haven sovereign debt. We're already seeing, and this is interesting, Jason, we're already seeing like Italian yields are up 50 basis points this month already. Portuguese yields 50 basis points. French, I think it's 40. So we're already seeing the market start to adjust at the periphery, and that's where they always adjust first, at the periphery for a different monetary backdrop. And the way it usually works, and this is certainly the way we saw it in 2007, it started at subprime, and it took a while, it took 18 months, but it made it to the core of the financial markets. I think now we're seeing, again, issues at the periphery. And if we have waning global QE, then I think this periphery issue will start to move towards the core. So I think this is starting now. We, here in the U.S., it's king dollar, U.S. security markets are the greatest in the world and all of this. But I think we'll keep our global focus and follow the analysis quickly and look for these signs of maybe a little risk aversion, a little deleveraging globally.
And the dollar may be strengthening, but the bond market may have entered a bear market after a 35-plus year bond bull market. Since Donald Trump won the election, the 10-year U.S. Treasury yield has gone from 1.3, where it bottomed, to 2.6 in only 6 months, and now it's correcting from that a little bit. But we have bond experts and billionaire financial experts like Stanley Druckenmiller and Jeff Gundlach saying that they could see 6% on the 10-year U.S. Treasury yields by the end of 2017. So that's pretty crazy. If we get up to those levels, we are probably going to have another financial crisis in the near future.
A lot of things are changing, and we talk about the geopolitics, and China has been aggressively selling U.S. treasuries. For example, a lot of the emerging markets have been selling treasuries. At the same time, these new policies that we're starting to see from the new administration, pressure on building more here, potential tariffs, trade friction, all of this is pro-inflation, right? If imports are going to cost more, things are going to cost more. We've also flooded the world with liquidity. We saw a significant increase in the price of crude oil, the most important commodity. So inflation now, I think the momentum has shifted. Maybe not dramatic, but it's shifted. So I think we'll see that impact. We're already starting to see that impact yields. If we don't have QE, globally, we're going to have much less demand for sovereign debt. So I think we could get into an environment where the supply and demand dynamics for government debt change significantly, right? We have less demand in a huge issuance with rising yields, rising short-term interest rates, and rising funding costs. I could see government yields move significantly. 6% sounds. That's pretty extreme to me, but what would a 4% 10-year yield mean? I think that would not be friendly for equities.
I want to ask you about the history of tariffs since you've been in the money management business for so long. There's a lot of the U.S.'s trade partners that have tariffs on U.S. goods when they come into those countries, but the U.S. hasn't had a lot of very high tariffs for a long time. Historically, do tariffs really help an economy, or do you just think that as a free market Austrian school leaning person, that they just hurt basically the U.S. consumer, someone like the U.S. consumer and savers, and they hurt the purchasing power of someone in their currency and their standard of living?
Yeah, I'm a free trade guy. I'm a free market guy. We haven't seen either of those. I mean, these are not free markets with all the government intervention, the central bank intervention. And I don't believe it's free trade. And, I have a little bit different angle that I take with this. The problem I've had, and this goes back to the early 1990s, we moved down this policy path of basically trading financial claims for imports. Why manufacture here when we can just create debt and buy them from anyone in the world and, run perpetual, large, sometimes enormous trade and current account deficits? To me, that's the problem. Not only did we deindustrialize our economy and turn to this service sector, finance-driven economy, we basically flooded the world with financial claims. And we've seen this unwieldy finance globally just cause booms and busts and devastation going back to, you can go back to 94, 95 in Mexico, 96, 97 in Southeast Asia, and, include Brazil, Argentina. You can go right down the list, right? So I want us to have an industrial base here in this country so we don't have to export liquidity and destabilize the world and destabilize our own markets. This isn't going to go smoothly. I mean, this is a major economic restructuring, a major restructuring of finance. There'll be a major dislocation, but I think you have to do that because we can't continue to just flood the world with claims of dubious value down the road.
But Doug, tariffs worry me because I think they may be the wrong way to accomplish. I agree with your goals, but I think tariffs might be the wrong way to accomplish that. What worries me, when I go back through financial history, is Smoot-Hawley. So getting into trade wars, resource wars, you're going to destroy another country's economy. The cost of living is going to soar. So I think, what Trump can do, and he's already kind of doing this, is, cut rules and regulations, cut taxes for small and medium-sized businesses, be pro-growth, pro-entrepreneur type of president, where there's not much taxes, rules, and regulations on the small businessmen who can actually grow their businesses and create value-added jobs, new products and services, where corporations will bring back their money instead of, stupid stock buybacks or a one-time dividend. The corporations will, invest in property, plant, and equipment in the U.S., create a tax policy for that. I'd rather see those things done instead of, big tariffs. I think those would be better for the U.S.'s economy long-term than tariffs.
Yeah, I agree with you completely, Jason. Yeah, I agree. I'm not pro-tariff at all. I just almost feel like it's almost a natural evolution of how this is all played out. The Chinese have invested, trillions in their export sector. They're not going to back away from their commitment to, importing goods to the U.S. Without some type of force. I just don't see how this can be resolved without a lot of friction with our trade partners. It's unfortunate. I wish we could just deregulate and everything would be fine. I don't think that'll be enough. So.
Yeah, the other countries have been using, mercantilist policy for a long time. They've been playing games with their currencies to devalue. Not that the U.S. is not doing this also. I think every country is basically trying to devalue their currency, although like the U.S., Japan, the Bank of England, and the European Central Bank are, in a separate currency block because they're in the G8. So they basically coordinate within each other versus the rest of the world about when to devalue their currencies. But yeah, I mean, there's these other countries, whether it's Japan or China. If you're an American auto company, you can't sell your cars to Japan or China because there's huge tariffs on there to bring in your to compete in there. So I mean, there's no free markets. It's just really sad that free trade and free markets are blamed when we don't have these things.
Right, I'm just go ahead, Jason.
Okay, finish your point, and I'll move on to the next point. Question.
Yeah, I was just going to say that it's been frustrating for me over the years because the U.S. we were kind of taking responsibility for global finance, and we did a very poor job. And China should never have been able to borrow unlimited, they should never have had that amount of cheap finance to build up that type of manufacturing capacity. And you can say the same thing for for all of Asia and even for Mexico, right? It was the global finance. We provided unlimited cheap finance to whoever wanted to build manufacturing capacity while we deindustrialized. It was, I think it was crazy. And now, unfortunately, we're going to have to deal with the consequences of all this overcapacity and all these trade imbalances, economic maladjustment, financial bubbles, and that's where we are today. And it's not going to go smoothly anywhere. But I don't see any way around a major adjustment.
Yeah, I completely agree. And I think we're going to see a lot worse global stagflation. The people on TV, on Bloomberg and CNBC may be calling it deflation if certain things, but they have a different definition of inflation and deflation. Boots on the ground here on Main Street, I see my bills going up, and it's tougher and tougher to find a higher paying full-time job. So I see stagflation getting worse here on Main Street. And if Trump is successful with some of his policies, Doug, I see either the velocity of money picking up or wage growth picking up with the tariffs. So that would create higher costs in the supply chain there. So I see a number of different ways for worsening stagflation going forward.
Yeah, I agree. I agree. That is, the bias is shifting out there. And I mean, this hasn't been deflation, right? Deflation is if you have this self-reinforcing credit collapse and downward valuations based on collapse in credit. That's not what this has been about. This has been about a bubble globally that financed unprecedented capacity to overproduce about everything, along with all of this technology, which is wonderful, but we have endless amounts of technology that we can manufacture or download. Fundamental changes in the supply of things people can spend their money on. Yeah. That's not deflation. That's just the evolution of the economic structure and everything else. So I think we'll continue to have plenty of technology to download, and that's going to continue to put some downward pressure on prices. But in the meantime, we have these other trade frictions and commodities and wage pressures and other things that will turn the tide for consumer price inflation. I mean, to me, credit is the inflation. If you create more credit, that creates purchasing power. It's Austrian. It just matters, where is that purchasing power directed? Well, most of this credit has been directed at asset prices. So we've again had enormous asset price inflation. One of the consequences, again, of this asset inflation is too much investment, especially in Asia, and lower consumer prices. But that is not deflation.
Exactly. The Austrian school definition of inflation is an increase in the money and credit supply, and then the effect is higher prices. So either higher asset prices or higher consumer prices are the effect. They're not the cause of inflation. And I think we've had, really big increases in money and credit. I think there was only deflation, Doug, for maybe 6 months where the credit supply dropped a very tiny amount. During the 2008 financial crisis, there was Chris Martenson, I don't know if you've seen it in his new Crash Course video, he had a tiny little blip, a drop in the credit supply, and that almost collapsed everything. And then the central bank stepped in and started booming the credit supply like crazy again to prevent that. So, the only real deflation we've had was that tiny little blip there in the recent past, in my opinion.
Right. Well, we had a significant de-risking, deleveraging that was reversed, and then I called it the global government finance bubble because you had enormous growth in central bank credit and you had enormous growth in sovereign debt. There was never deleveraging outside of, over a period of weeks, really.
Yeah, I mean, people on Main Street have had to delever maybe because they can't borrow nearly as much. Credit card interest rates are higher for regular people on Main Street. But yeah, large corporations, many different governments, large investment banks, hedge funds, they haven't had to delever. So they're still booming with their how much they can borrow in credit. I want to ask you as a money manager your opinion, though, about the cashless society and the cashless economy. Obviously, if you're managing money, you have to have some cash on the sidelines for opportunity. Are you worried about these governments then and coming in with policy and starting to charge a couple percentage points then for cash in the bank?
Well, it's very difficult to even know, when we talk about money and cash and, what does it mean, right? What is money today? To to me, today's money, we're talking about electronic debits and credits. We're talking about, journal entries. I know in India, for example, right, they want to restrict cash because of the underground economy, and there's different reasons. Other times, the central bank, right, I think one of the motivations to take interest rates to zero was to force savers into the risk asset markets. So there's all kinds of different motivations, and I just wish the government would get out of this and let people decide for themselves, what kind of cash they want to hold. Yeah, I'm concerned about it because the government is already so aggressive, and these markets are already distorted. The last thing we need is penalizing people for trying to protect themselves and to invest in more of a safe haven. It's ridiculous.
Yeah, I completely agree. People should have the freedom to have savings in cash. And, if they want to hold gold and silver, as an American, you shouldn't be taxed you shouldn't be taxed as ordinary income. It should count as money. I think there's a petition going around now from Gold Money to send to President Trump's desk to eliminate all the taxes now on gold and silver, so it only counts as money and you don't pay tax for buying gold and silver and you can hold it like cash. So that would be awesome. But it scares me with negative interest rates, the books and white papers these guys like Larry Summers and Ken Rogoff and Paul Krugman are putting out. It seems like they're doubling down on their policies, Doug. It doesn't make any sense. These guys, I guess, are paid government stooges.
Well, throughout history, it's always been called inflationism. And once you go down that track, there's no turning back. That's the problem. Once you start to inflate, there's never a convenient time to say, okay, we've done enough. And throughout history is always, okay, one more year, we'll print some money and then we won't do it anymore. Well, they can never back away. And now it's the, different types of sophisticated policies and sophisticated analysis, but it's all one way or the other. And, inflationism and forcing people to continue to play in the risk markets, right? And to me, it's just all unfortunate.
When you started your career in the financial industry, did you imagine that you would see a guy go on Bloomberg or CNBC with a book called The Curse of Cash and actually get respect from the journalists on there about banning, $100 bills, $20 bills, $10 bills, because, only bad people, drug dealers, criminals use cash now, according to them?
Well, there are a lot of things that I can't believe. I never believed, I can't believe that people buy into QE, right? That central banks can just create new money and that makes sense and that they are basically just going to do it forever. So, yeah, this is, Jason, you've read so much financial history. You probably agree when you read about it, right? When you read about these different periods and these different financial fiascos, and you think, how could people have believed it? How could they have bought into that nonsense? Well, now we know because we've witnessed it, and it is amazing what people will believe when they really want to believe, right?
Yeah, I agree. I think it's hopium. I think they trust the government, way too much. I think, they've been raised or brainwashed and to grow up to trust the government, that the government has their best interests in mind. And we're going to find out very soon that that's not the case.
Well, but Jason, these bubbles are very seductive, right? We had Dow 20,000 last week, right? So, it's easy for the policymakers to believe that what they've done is incredibly good, right? Mm-hmm. Chairman Bernanke believes that his policies were amazing, right? So they believe it all works, and of course, people in the marketplace, these guys, they've got it figured out. They've got our backs. So it's groupthink. Everybody wants to believe it makes sense, but if you stand back and look at it, it doesn't make any sense at all. But it's been going on for so many years that people that have been worrying about it, like myself, right? Who's going to listen to us, right? And that's just the nature of these long, prolonged, epic bubbles.
Yeah, I mean, the government and the central banks and the politicians and the bureaucrats just keep changing the rules. So, you're not giving out timing saying, there's going to be a crash every 2 or 3 months. I've followed your work for years, and I haven't seen you say anything like that. But you've just been warning people that, this is getting bigger and bigger. The misallocations of money and credit are just getting larger and larger, and eventually there's going to be a huge price to pay for this. So, one of the things about the Austrian School of Economics is we don't put timing on stuff. So we just talk about the problems that are going on in the economy, and we don't try to give exact predictions. That's not what Austrian School of Economics is meant for.
Yeah, and as an analyst of bubbles, I quip that bubbles go to unimaginable extremes and then double, right? I mean, NASDAQ almost doubled in 1999, and I was going, you're kidding me at the time. You're kidding me. And even after subprime in 2007, right, the markets went to all-time highs. So markets can do crazy things when they're over-liquefied and they're very speculative, and the view is that central bankers are there to backstop liquidity. And as we've seen, these things can go on for years.
Exactly. And most market participants, Doug, are not exactly rational players. Most of the people in markets, even professionals, they have a problem with this. They can get over emotional with greed and fear. So
it's greed and fear, but I sympathize with financial advisors, with some fund managers in the marketplace, because they have to jump on board. I mean, you'll risk your career. You'll risk the livelihood to take care of your family if you do not participate, right? And it's not easy for financial advisors, and they can't go back to their clients year after year and say, I'm nervous. I don't like the way this looks unstable to me. This is a bubble. This could burst. After a while, nobody wants to hear it. And if you want to work in the industry, you gotta buy into the bull case and play. And it's unfortunate, but that's kind of the reality of how it works.
Yeah, this is setting up for what the hot potato or musical chairs, and this is not going to end very well for a lot of different people. I want to ask you before I let you go about how do you do research for shorting opportunities? What goes into your process? Do you do bottom up and top down? Do you look at the company's balance sheets? Do you look at stock charts to see that something's breaking? Maybe it just broke below the 200-day moving average. What types of things for our listeners out there who are thinking about shorting? How would they go about the process of starting to do research for shorting?
Sure, and Jason, what I'm going to do is I don't think shorting, especially in this environment, is appropriate for the average person. Because when you short, you don't know what your risk is, right? If you buy a stock at $5 and it goes to zero, you lost $5. If you short it at $5 and you go to 25 and it goes to 25, you've got a huge loss. So if you're going to short, you have to have risk control. And that makes it very difficult in these types of markets, because you could be right on your fundamental analysis, but the stock's going up, there's a big market rally, a big short squeeze. You have to impose your risk control, get out of that position with a loss, and then you might be right fundamentally and the stock goes down, but you've already gotten out. So when I started in the industry back in 1990, the focus was on company balance sheets, just hardcore. We wanted to analyze companies much better than the bulls would. We wanted to study cash flows and the company fundamentals. Well, that type of analysis over time didn't work as well as financial conditions loosened so much. Right now, my focus is much more top-down. I like to have top-down meets bottom-up. But right now, the top-down is the key. That's going to create the opportunities on the short side, is when you see risk off start to unfold. And then what you want to do is you want to see the top-down start to unfold and then target the companies or the sectors that you think are most vulnerable to the changing macro environment. But Jason, that is so difficult. I mean, it's difficult for me, and I've been doing this for 25 years. I love it. I don't want to do anything else, but I don't necessarily recommend it for my 8-year-old who when he grows up, and I don't recommend it for most people in the marketplace.
Yeah, those are good points. And plus, even if you're right, shorts get hated. I mean, politicians, politicians can call it the shorts. It's your evil, greedy speculators' fault why the banks collapsed, or it's the evil, greedy speculators' fault why there was a mortgage-backed security crisis. Not because, they were giving out bad loans to people who they knew they couldn't pay, and then, splicing up the securities and dicing them up into tranches and selling them off to sucker pension fund managers who didn't do any research, but they're blaming the speculators who shorted the market, which is ridiculous because for every market you need a buyer and a seller. So it's just it's really sad with the shorts who do good, honest work and they put their money where their mouth is and make a speculative bet that they get blamed for things that are not their fault.
Yeah, and it's the harsh reality of speculative markets and what central banks have created. And yeah, these are not normal markets. Yeah, but for me, I don't go out and talk about what I'm short. I don't go on TV saying when I'm short. I keep a low profile, and I think doing the type of work I do, that's probably better just to keep a low profile and try to have the white hat on and write some commentary that hopefully explains some things and try to be a good guy and not be considered some evil short seller that's trying to bring, spread rumors or whatever and bring the stock price down. You don't like that either, right?
No, I don't like that either. Jim Cramer, I think, there was a video of him doing it when he was a hedge fund manager. I can't remember if he was long or short. He may have done it on both, but he was admitting he spread the rumors in there and he was already long or short of stock, and he spread rumors to people on television when he was a hedge fund manager for extra profits, which is illegal. Yeah.
Yeah, there's all kinds of nonsense that's happened over the years. Again, that's the nature of speculative markets. Regrettably.
Well, Doug, it's been a very interesting conversation. I'm glad I got to speak to you for 50 minutes. If our listeners want to follow your work, how do they do so? And tell our listeners also about the new fund that you have opened up with McAlvany Financial.
Yeah, right now I'm posting my blog. It's at creditbubblebulletin.blogspot.com, or you can just search my name. Yeah, I'm really excited to work with David McAlvany. He is just such a talented, super guy. I feel fortunate to, that he wants to work with me, and we're going to put together a new short product. We're still working on the details, so I'm not going to talk too much about the details. But I think the environment's shifting, and I can't wait to get out and talk to people about the story and get out there and get our new product together. But we're going to be focusing on trying to make money on the downside, stocks, sectors, the market. Be very opportunistic. Be very focused on risk control, and try to put to work 25 years of experience and hopefully put together a better mousetrap as far as how to play the short side. So that's our vision, and there'll be much more to talk about in coming weeks. And Jason, thanks so much for having me on today. I really appreciate it.
Excellent. Well, I hope to have you back on in the near future. I've been trying for a while to get you on, so I enjoyed this conversation here. I enjoy learning the short seller's perspective on things because, they don't always like having you guys on TV on CNBC and Bloomberg because, they only like having the bulls on most of the time on TV, unfortunately.
They can have it. I prefer not to go on TV anyway, so it's fine with me.
Mo and I are trying to raise $1,000 per month for our Patreon account. We have over 2,600 viewers per YouTube video, so if we can get most of our loyal listeners or all of our loyal listeners to donate $1 per month or up to $5 per month, which would be amazing, that would cover most, if not all, of the money that we need. So we also accept one-time donations if you go to the wallstreetformainstreet.com website. We accept donations in cash via PayPal. Fiat, you can donate there. You can donate Bitcoin through our Bitcoin wallet there on the website, or you can donate gold and silver. We have a gold money account, and we also accept mailed donations of physical gold and silver. Thank you guys for listening, and we appreciate any and all help. Please forward it to friends. Okay, bye.